Imagine picking out a meal. You could order one expensive dish and hope it lives up to your expectations. Or you could choose a buffet where there are many dishes to choose from and the chance of disappointed is being lower. So which one would you pick? Investing works the same way. You can put all your money into one Nifty 50 stock and hope it performs well. Or you can invest in a Nifty ETF which spreads your money across 50 companies, giving you more variety and reducing risk. So you're not sure which option is better? In this video, I'll break down both your choices, explain how they work and help you figure out which one fits your investment. And by the end, you'll know exactly which approach makes the most sense for you. Before comparing stocks and ETFs, let's quickly understand what the Nifty 50 actually is. The Nifty 50 is a list of India's top 50 publicly traded companies, picked based on their market value and performance. These companies come from different industries. Reliance Industries, for example, is in the energy and telecom, and HDFC Bank is in finance, TCS and Infosys in IT, and Hindustan Unilever in consumer goods. The Nifty 50 is seen as the measure of the Indian stock market, showing how the country's biggest companies are doing. And over time, it's proven to be a strong performer, delivering an average return of around 12% per year over the last decade. When the Nifty 50 rises, it means that top companies are generally doing well. And when it falls, it indicates that many of them are struggling. Investing in a single stock is like betting on one player to carry the entire team. If they perform well, you win. But if they struggle, your chances of success drop. In the same way, relying on a single stock means your entire investment depends on its performance, which can be risky. If the company does well, your investment grows. Let's take Reliance Industries for an example. It's seen an average profit growth of nearly 19.4% per year over the last decade. That kind of growth can really boost your portfolio over time. So if you enjoy analyzing and researching individual stocks, then the Nifty 50 stocks might be a great fit for you. But if you prefer something more stable and less time-consuming, a Nifty ETF could be a better choice. This offers you a more hands-off approach. Now, let's look at Nifty ETFs. They have been a steady way to grow money, but returns can vary. Over the last 10 years, the Nifty 50 Total Returns Index has delivered over 14.2% annual returns. It may not skyrocket overnight like some individual stocks, but it's a reliable choice for long-term growth, kind of like planting a tree and watching it steadily grow over time. So why do so many investors prefer Nifty ETFs? First, Nifty ETFs is diversified. Your money is divided among top 50 stocks rather than just one. If one stock falls, the others balance it out. It's similar to a team. One member might fail, but the team still can win. Second, they're cost-effective. Buying one ETF is less expensive than purchasing multiple equities separately. You get diversification at a much lesser cost. Thirdly, they require less research. The Nifty ETF tracks the market trend, so you do not need to keep track of each individual stock. So which one would you choose? If you're still unsure, let's go back to the buffet example. Some people like to pick individual dishes, carefully choosing what looks best. Others might prefer a pre-made platter that has a bit of everything, making it an easier choice with a good balance. At the end of the day, it all comes down to your financial goals and how much risk you are comfortable with. So tell me, which investment style do you prefer? Do you like the focused approach of a Nifty 50 stock, or do you prefer the diversification of Nifty ETF? Let us know in the comments. And if this video has helped you, hit the like, share and subscribe for more investing insights. So see you in the next one, and happy investing.